All right, so in this video, I'm going to talk a little bit about the importance of the stock cycle as it relates to investing. One of the reasons we might care about the stock market cycle as it relates to investing is because there's sort of different phases of kind of how the stock market goes up and down, and different stocks do well in different economic environments and in different phases. And so, from that perspective, if you want to properly diversify, it might be helpful to make sure you have investments that do well in different sort of economic environments and in different stock market circumstances and so forth. And if you were going to pursue a sector rotation strategy, which there are some money managers that do things like that, you would want to understand how the stock market cycle works to try to better utilize those mutual funds, ETFs, or whatever portfolio you're constructing of these different types of stocks in order to implement that kind of sector rotation strategy. Another possibility would be to use information pertaining to the stock market cycle in order to allocate better between stocks, cash, bonds, basically different asset classes, and to figure out, should I have more cash at certain kind of market circumstances, or should I have more stocks? And ultimately, some of that is going to be related to your investment philosophy. If you're doing more of a passive strategy, it's going to be more of a index, keep fees the lowest possible, invest in a nice diversified portfolio, and then leave it alone, right? If you're being a little bit more active, you might start adjusting the allocations based upon your assessment of market conditions and so forth. If you really went down this path, you could possibly try to engage in long short portfolios. Long meaning you buy stocks, short meaning you short sell stocks. So you could try to go long on stocks you expect to do well soon in the economic environment that you're in, and short sell stocks you expect to do very poorly in the economic cycle you're about to head into, and try to create a long short portfolio and things like that based on stock characteristics, business cycle exposures, and so forth. That gets more advanced and more tricky because in that case you sort of need to be right about what's going to do well and also possibly right about what's going to do poorly. So that gets a little bit tricky and doesn't necessarily always work out the best. As a general concept, think about the stock market cycle and things like that, if you have some particular asset class or group of stocks or things of that nature that have been generating really high returns recently, that should concern you a bit. That doesn't mean it's imminently going to fall or anything like that, but generally that would probably mean, if anything, there might be a case to be made for rotating away from that and into something else. That's not an automatic. It's more of should be a thought process of, are we sure this is going to continue to perform well? Why am I assessing that this would continue to perform well, and so forth? Because oftentimes what happens is things do well for a period and then they do poorly, right? But if you chase after the things that have been doing well, you tend to keep buying near the top of all these different asset classes, and that tends to end badly. Um, so from that standpoint, you have to be kind of careful to not get into chasing returns. Chasing returns, where you're buying into things that have recently done well, that tends to end rather poorly. And so that would be another reason why we would care about the stock market cycle as it relates to investing. Hopefully this video has been helpful. Thank you so much for watching, and have a great day.